hope everyone is doing well. You are someone who has multiple questions in your mind about some basic concepts, maybe business, career, or maybe something related to your interest. So here is the platform we are getting forward, an interesting series by the Rotaract Club of Margao, and that's Vaani. Today we are touching upon the topic of financial literacy, and we are having amongst us the passionate finance doctor who is a dental surgeon by profession. He is associated with Lions Club, BNI Matagram, and has contributed his dedicated service to the Dental Association as a president. He has authored 6 interesting books, and the leading book is Who Says Money Does Not Grow on Trees. The book is highly regarded and awarded by MFRT Awards. It's an honor to have the finance doctor, Dr.Celso. We welcome you, sir. So your journey of diving into finance has been quite interesting. Can you tell us something more about it? How did you churn out into being a finance doctor?
Okay. Actually speaking, my profession was dental surgeon. And I have been a dental surgeon from 1991 till 2008. Actually even till 2018. But actually speaking, in 2008, after setting up 3 clinics and a lab, I suddenly realized that I'm still a daily wage worker. Which means the day I don't go to the clinic, my income is 0. And the biggest shock which happened at that time was 18 years I have worked. Money was coming, money was going. But where it was going, I didn't know myself. And at the end of it, even after 18 years, when I realized that I'm a daily wage worker, even being a doctor, I said there is something wrong. And then what I realized is, even though I was the secretary of the Dental Association, World Dental Association, we organized number of seminars, but not even one seminar was in finance. We had practice management seminar, that's how to manage your clinic. But as far as finance, we never had, like how to plan your taxes, what is equity markets, what is shares, all these things we were never taught. So much so that I've seen we were actually cheated and given away by the insurance company. In the sense, we were thinking insurance is an investment, when actually it was one of the biggest mistakes that we had done, because insurance is for protection, investments is for returns. So that is how we learned the thing, and then I started taking a lot of interest in this, and I somehow made a poster in my clinic that before 50 I will retire with a pension of at least 1 lakh per month. Now whether I continue or not makes no difference, but I need 1 lakh pension per month. So that poster, by looking at it and visualizing it, somehow I achieved it. And by 2018, I could retire from the industry.
That's a great experience, and learning from your own self is something which is great and appreciable. So, today we would like to touch upon some basic concept that everyone should know as awareness of financial literacy. So sir, we have some few questions, and it would be great if you can address our viewers on that. So the term financial planning for an individual is quite a wide concept, and people have a lot of assumptions on it. Would you like to define it in a very simpler manner wherein everyone could take a note of things?
Okay, financial planning actually is just a broad subject, as it is like you have to plan for anything.
Exactly.
Without planning, you can't achieve any goals. So in financial planning, it's basically planning for your goals which you want to achieve in life, like your retirement or your child's education, or you want to go for a foreign trip, build a house, all those are goals. So, but basically what happens, financial planning is a very broad subject, but what I have realized is, if you understand only 3 words, automatically your life will change completely. And these 3 words are basically a saver, an investor and a trader. If you know the difference between these 3 people, automatically you will come to know why savers are destined to become poor, why the traders are supposed to be daily wage workers, and whereas investors become rich. But now, what is the difference between the 3? A saver thinks more about protection and about his future. So he saves money for the rainy day. Now where he saves, it might be in mutual funds, it might be in the bank, it might be in the post office, it can be anywhere. But the intention is to save it for the future, so that his future is protected. And let me tell you, even beggars do it. So much so that I have seen beggars, they live poor but they die rich. And that is what is called saving. If you take second category, it's called as trading. Now traders are the ones who buy, sell, and book profits. So their focus is more on returns or profits. So they want to see that where I can get maximum profit. So they try to do trading at different places. It can be their own business or it can be in somebody else's business. So you do trading, but the thing is, the day you stop it, income stops.
Yes.
So it's basically a daily wage worker's job. Or the better term I would say is dating. Dating means looking for short-term pleasures. Okay, so trading is basically like dating, that is for sure. And so much so, I spent even about 6 lakh rupees to enroll for online trading academy to learn about futures, options, commodities, derivatives, all these things I have learned. But the idea is, once you go into it and you get addicted to it, then you have to give up your life completely, because finally money will just keep rolling. The day you stop it, income stops. Then comes the most important, which is called as investing. Investing is basically becoming an owner and having that ownership. Like now, say for example, if you want to own a business, then you invest in a business. If you want to make it a partnership, you put your quota and you invest in that business. Now, once you invest in the business, you have to be with it in good times and in bad times. So like now, say for example, in shares. Suppose by chance you decide to invest in any company, just name any company, which company you would decide?
Maybe Infosys.
Okay, now let's take Infosys. Now suppose by chance I want to invest in Infosys. First thing I should have in my mind is I want to become an owner of Infosys. So if I'm becoming an owner, before I buy, I will do a small research. And I will find out at least in the last 1 year what was the highest and what was the lowest price of this. But the moment I decide to invest in Infosys, I should remain with Infosys for life and enjoy dividends out of it, but not buy, sell. If I buy and sell, then I'm doing trading, which is called as dating. Then I can take as many as I want. But imagine if someone had to start investing in Infosys 10 years back and started with a small amount, and now in 10 years has accumulated around 1 lakh shares of it. Every year Infosys gives you dividends, every alternate year you get bonus shares, and that's how your investment starts increasing. So the moment you become an investor, you should be an owner. So don't look for short-term profits, but look at long-term returns. So that is what is called investing. Now if you take in mutual funds, very easy to grow rich. Now you select a good fund, start investing, but start focusing on ownership, wherein you say, I own 50,000 units in this fund, or I own 1 lakh units in this fund. The price goes up on its own with inflation. Say suppose by chance you have started a fund which is today at 50 rupees. With inflation, the NEV will go up to 100 rupees within 3 to 4 years, or maximum might be 5 years. But imagine in this 5 years, you manage to accumulate 1 lakh units from 50 to 100. So your average buying price will be somewhere around 60 to 65. Today's price is 100, but 100 into 1 lakh is 1 crore. And the difference between 100 and 65 is 35 rupees. 35 rupees into 1 lakh is 35 lakh rupees profit. Now, suppose by chance you just hold on to those 1 lakh units, stop investing but hold on to it. Price from 100 rupees with inflation will go to 120 within 1 year, approximately, or it might even go to 110. But if it goes up by 10 rupees and you have 1 lakh units, you are making 10 lakh rupees profit without working. Now these are called investors who make money without working. Whereas traders, they have to buy and sell and make money on that day. So if you become an owner, then you become an investor. If you do trading, it's like you have to do it daily. And let me tell you, all poor people are savers, middle class are traders, rich people are investors. So if you understand only these 3 words, 90% of our job is done. And let me tell you, the moment you start getting married to a company, only then you will get results. But before getting married, please analyze, like how it's normally done. And that is rule of nature. And what I found is, bad moments come only the first 3 years. After 3 years, it's very difficult to get negative moments, like those red moments. Red moments is basically when the price is below what you bought last year.
Yes.
As far as being in the mutual fund or even in shares is concerned, it is exactly, once you invest, it's basically like marriage. First 3 years, there will be many ups and downs. So which means there are some red moments and green moments. Red moments are basically when the price goes below what you had bought before. and red means green movements is above, and red movements is when the price comes down. Now, actually speaking, if you're an investor, you will always be happy when there is a red movement. Whereas if you're a saver, you'll always be sad when it's a red movement. So the way your mind looks at it, based on that, accordingly you will understand the concept of it. So if you start investing early, like I'll just give an example. We have one student who started investing when she was in college, and we had given her a fund which was at 10 rupees. Okay, she started with an SIP of 1000 rupees, and just after 2 years of college, she started working. But her salary was just 10,000 rupees. But she followed the rule that is 5,000 I invest, 5,000 I spend. And with this, today she's 25, but she has 70,000 units in this fund, and the NAV has touched 25 rupees. So 70,000 into 25 is a net worth as on today at the age of 25, which is more than $1 million.
True.
So who says it's difficult to grow rich in India?
Big time.
But why she has become rich is because she stuck to one fund and she has been with that fund. And now anybody remains with one mutual fund, whether it's a good fund or a bad fund, it doesn't make any difference. Because over a period of 7 years, we have analyzed and seen all the funds, the returns come to almost the same at the end of 7 years. Because in the worst performing fund, NAV growth is slow, but the number of units is more.
Yes.
In the best performing, NAV growth is higher, but number of units is less. And finally, how is the profit calculated? Number of units into the difference. So that is how it becomes almost equal after 7 years. But unfortunately, why people don't grow rich is because they do trading in mutual funds. They keep on dating with many funds. And every fund is changed after every 2 to 3 years. So nobody remains with one fund for more than 5 years. And that is MFI data which has given us that majority of the people change the fund every 2 to 3 years. So when you change the fund, it's like you plant an apple sapling in the front yard, wait and watch for 2 years, you see no fruits, so take it out from there, put it in the backyard. Again it will take 2 years. Then to make up for the time, you're losing on time when you keep changing the fund. But when you put it in one fund and your focus is on units and say that I will accumulate 1 lakh units in the next 5 years. After that you can even stop. On its own it will start growing based on the NAV. And NAV goes up with inflation at all.
True.
So when inflation is like a blessing for India because of the population, we have to take benefit out of it. And that is what we are trying to educate people on what is the difference between saving, investing and trading. So if you want to grow rich, you need to know how to invest and not just save.
So you have made it very simple for our viewers from the terminology of savers, investors and traders. That's great to hear from you, sir. And unknowingly you have answered the question that what age is the right to invest. So thank you so much.
Actually speaking, when you ask the question, what is the right age to start investing? If I ask you the simple question like what is the right age to plant a tree? If you have planted it, you have to make it grow. So the earlier you start, the earlier you get. Because I'll tell you, growing a money plant and investing is almost the same. First 3 years or even up to 5 years, it grows only below ground. After that, then it starts gaining height. So I was to think why and go to see, unless and until the roots are strong, the height cannot be gained. Otherwise, with the breeze, it will generally go off. So in investing also, the first 3 to 5 years is basically accumulation phase. Growth phase is after the 3rd or 5th year, you can say, and returns usually start coming after the 10th year. It's also, you can compare it with a small child. When the baby is born, you need to feed it regularly. So same way this money plant has to be fed regularly. Many times the child will fall. Same way here also the markets will fall. And every time it falls, you need to give a top up. So that is how basically this money plant grows. But you had asked another question which was somewhere around where to invest. Okay, now the thing is like this. Anything which is an asset which is appreciating in value is worth investing in.
Okay.
Main thing is it should appreciate in value. And today, if you notice, the biggest asset which actually gives the highest returns is basically businesses. So many people invest into businesses or real estate. But real estate, you need bigger amounts. Into businesses, you can put even small amounts and start whatever price you want. And the best part I like about businesses is it's so flexible, it's so transparent, you get tax benefits, you get so many things that you can just keep on investing in any business. But if you invest in your business, basically you need to work 24/7. When you invest in somebody else's business, it's they who are working for you and giving the dividends. And if you check and see any rich person, he will always say, I own these many shares of this company, or I own this much percentage of this company. And that is how the thing goes. Either you invest in your own business, or you can start investing into real estate. So now what I have noticed is real estate as an investment, you require a huge capital. And the main problem is there is no liquidity whenever you want it. Tax also is the highest in real estate because your capital gains is almost 20%. As compared to equity, wherein the liquidity and flexibility is very high, and you can put as much as you want, and the flexibility is totally this, and it's all transparent. Means each and every rupee that you spend will come on your statement, including the commissions, everything comes on your statement. So the transparency is very, very high as far as equity is concerned, like whether it's mutual funds or even shares. So even in your share trading, it will show what is the brokerage charge. So all these brokerages, everything is disclosed in this. But now as far as returns is concerned, I can't find returns anything better than equity in India. And let me tell you, the whole world is actually jealous about India, except Indians. Why? Because we have not observed what is the potential. Because for me, the biggest learnings as far as India is concerned is, I was just doing a survey report as far as UK is concerned. UK's population today is about 66 million. Whereas Karnataka's population is 65 million. So you can imagine the entire UK is equal to Karnataka. So imagine what is India when you see Karnataka. Okay, if I give you slightly more stunning figures, when I had gone to Australia and the tour guide was mentioning, the total population of Australia is 28 million, out of which the highest is in Melbourne, which is 8 million. Then comes Sydney. And the surprising thing when he told us is, I just checked it up on Google, Mumbai's population is equal to Australia's population. So you can imagine where is India. And recently I checked it out, population of United States of America and the population of Uttar Pradesh and Bihar together is the same. So can you imagine what is India? And imagine the consumption that India has, especially as far as petroleum is concerned, especially as far as crude oil is concerned. With this consumption, we are importing more than what we are exporting. So automatically fiscal deficit has to increase. Dollar rate goes up. So as the dollar rate goes up, prices go up. So who benefits in this are the businesses, not the savers. Savers will lose their money whenever it comes. So if you don't start investing, you cannot actually make money work for you. So the best way of that is only remember this one sentence. Investing is like getting married. Trading is like dating. Now people who do trading will never become rich. I can challenge anybody who is doing trading to become rich. If he becomes rich one night, the next night he'll become poor, because that same money will start rolling again and again. So when you roll your money doesn't grow. But when you invest your money, you start getting returns out of it. So you need to create an asset, and this asset can be in the form of a business. Or you become a business owner and you see the results. It's terrific.
Totally. The dating and marriage thing is quite a good example for our viewers, because marriage is also should be a long-term commitment, and dating is a short call. So yes, that's a good example. Just following the same line, is gold a right option to be considered to invest?
Okay, now coming to gold, let me tell you another thing. Gold is normally a saving item. It is normally the poor people who would like to have security. And gold is normally given as a security, especially for the females. It is more of a security. It doesn't give you any returns unless and until you sell it. But when you sell it, you start trading. But if you keep gold in a locker, you will not even earn 2% interest on it. So even that interest what you get on gold is very, very low. So it cannot be an investment, it can be more of a saving. So saving in gold is okay, but that is more for security. And normally speaking, who are the ones who save in gold are usually the poor and the middle class. Rich people, they don't invest in gold because gold doesn't give you returns unless and until you sell it. So when you sell, it becomes a trade. But what is investment is, I'm owning it and I'm generating income out of it. Can you generate income from gold?
Not
unless you sell it.
Yeah.
But once you sell it, you are no more an owner. So it becomes a trade. How can you become an investor with gold?
That answers our audience because they will now understand, following your previous concept of trading and investing, and whether they will not have the component of ownership already.
Rich people are usually people who have invested their money into equities and businesses. So when you put into businesses or equity, you get returns more than 100%. So now what happens, once you become an owner and you start getting that passive income, like now say for example, we have got this E-flat concept.
Yeah.
Wherein you put 80 lakhs or even 50 lakhs or even 10 lakhs. We are giving you 6% interest every month guaranteed. In the sense like 0.5% per month. Like now we have got a client who has put 80 lakhs. He's getting 40,000 every month from that 80 lakhs. And it is guaranteed on a fixed date. Like on the first of every month he gets 40,000, and that also tax is very minimal, which is only 10% capital gains when it crosses more than 1 lakh. But 40,000 comes to this. At the same time, this 80 lakhs also appreciates because it's growing more than 10%.
10%.
Here we are taking out 6%. So this is growing, and the best part is, suppose by chance he wants to sell only the bathroom, it's only about 5 lakhs. He can take out 5 lakhs from it and do it, and it's a virtual flat. So he can take it wherever he wants. Even if he's in the US, he can still own it. Like how we have virtual currencies like
Virtual foundation or something like that.
Yeah, so here you don't actually have the physical thing, but you own it and you start generating income out of it. And the best part is it's liquid. You can sell it off within 3 days, money comes. You don't have to wait for a buyer for it. And that way you enjoy much more rather than having actual flat and not getting rent only in it. Then it becomes a liability. People are focusing on assets which are like this, like the real ones, but the loss is much higher. Because today what I've seen is people are wealthy, but they are not rich. Because rich and wealthy are totally different. If you invest, like if you have 100 rupees, for every 100 rupees that you earn, keep 5 rupees aside for your insurance. The first thing that comes is your insurance. So 5% of your salary should always go into insurance. 25% goes into your investments. And 70% is for your expenses as well as small savings. If you follow this rule of keeping yourself 5% for insurance, 25% for investments, and then spending 70%, and do this just for 100 months, by the time you reach your 101 month, you will get a passive income which is equal to your earned income, wherein you have 2 cakes instead of 1. And if you do it just for 20 months extra, that is 10 years, that is 120 months, it will be double of what you're earning, and then you become financially free. But the rule is, and this rule has been applied right from independence by the government of India, wherein from your salary, 12.5% is to be taken from your salary towards GPF, and 12.5% is contributed by yourself. So automatically this 25% which was there as a saving, which was compulsory. But now, that time India was a poor country, Provident Fund rates were almost 22%. So from there, now India has become the 5th richest country, and the interest rates on savings is touched 3.5%. So what PPF was at that time, equity is now. So instead of putting money into PPF, if you put into ELSS, that is equity linked savings schemes, which involves equity, automatically your returns can be high. Even NPS is also related to equity. So why government has introduced NPS is so that people stop going from PPF to NPS. So that in NPS, your average returns comes to almost 12 to 14% as compared to 7% what you will get in PPF. But the tax benefit is the same. There is no difference at all. But still, the number of accounts in NPS has not even reached to 1/4 or 1/5 of what PPF has got. So PPF accounts are still the olden methods of doing, which is like for saving. NPS is for investing. And same thing, equity markets, if you want to put it, and if you believe in India, then you cannot just avoid investing. So the formula is 5, 25, 70.
Okay.
So for every rupee you earn, say for every 100 rupees you earn, keep 5 rupees towards your insurance. And I always say first is insurance. Why? Because insurance is the foundation to your wealth creation.
True.
Because if you don't have insurance and you have wealth, it can just disappear in one day. And the recent example of Rakesh Jhunjhunwala will tell you exactly. He himself said it, I had so much of wealth, but I did not have health. So health insurance and investing in your health is also very important if you want to become rich. Because having money and having no health, you can't enjoy life. So if you want to enjoy life, you have to manage it. So if you can manage by keeping aside 30% and then spending 70%, you can easily enjoy life. That's the easiest formula I can tell you.
Loved it, sir. Totally. The 70, 25 and 5 policy is going to rock, and it's going to help all our viewers to invest in a particular pattern. So the next question which we have is to understand the passive incomes. What would you suggest us is the right framework when it comes to passive income, and some correct mediums where we can invest?
Actually speaking, see, passive income is basically defined as money which you make without working. In the sense you make it while sleeping. Now, normally speaking, the higher the passive the income, automatically the more the financial freedom. And only if you have financial freedom, then only you can become rich. Without financial freedom, you cannot become rich. So how to create this passive income is basically by creating either your portfolio or becoming an investor. Now, if you become an investor and say suppose by chance now today you own say 1 lakh shares of HDFC Bank, can you imagine the dividends that HDFC will pay you is somewhere approximately, I can say roughly around 15 to 18 rupees per share. So imagine earning 18 lakh rupees per year without working. How would you feel?
Yes.
And that also without even stepping into the bank. You have not even have an account with the bank, but you are the shareholder of it. This I've just given as an example. It doesn't mean say I'm marketing for HDFC or anything. It can be any company. Like now you said Infosys. So even say imagine you are an owner of Infosys, say around 1 lakh shares of Infosys. If not, take a mutual fund. Say suppose by chance you are a owner of a 1 lakh units or say 5 lakh units in a mutual fund which is just at 50 rupees today. After 50 rupees, you can stop and just own that 5 lakh units. Every year with inflation, even if it increases by 5 rupees, you are making 25 lakh rupees without working. Now that is called passive income. And the financial freedom that you have is terrific. In the sense, I have written a book who says money doesn't grow on trees. And I'll tell you, every time I need to buy something today, I just need to cut one branch of the tree. Like I'll give you an example. When I bought my Tata Harrier, it was costing 26 lakhs. But I could afford to do it because my portfolio is more than 3 crores. So I just cut 26 lakhs from that, took it out, and I bought the car. And the best part of it is that 26 lakhs was recovered within say maximum 6 months. Because that money plant is growing. So I have that financial freedom to choose what I want. So the earlier you do it, like I'll tell you, I became financially free only at 50, and that is the time when I decided to quit dentistry. Because now I didn't have to make money while working. I was making money whether I work or I don't work. So when you make money without working, and that also more than what you need, automatically you become financially free and you can choose the career that you want. So I decided to go and start financial literacy in colleges because I found Goa, not a single student, including MCOM, including MBA, knows what is the difference in saving and investing. Most of them are into trading. All of them have got Grow app, they have got different apps with like Zerodha and all accounts, and they do trading. Trading is what? Trading is basically like dating. You get pleasure only for that night. You just have to buy, sell, buy, sell, buy, sell. Every time you buy and sell, you are never the owner of it. So how will you make profits in it? And imagine if you check with all the MCOM students, even MBA students, they are having a portfolio like of 6 shares of HDFC, 10 shares of MRM. So they'll have 5-6 shares. So the earning per share is not at all viable. So if you want to go into shares, you have to talk of numbers. And if you want to stay with one company, you should be with that company in good times and in bad times. Like I'll give you my example, I'll just give you one typical example where I make huge amount of money. In 2018, I just decided to start buying shares of Apollo Tyres. And at that time when I was doing research, it was showing as a heavy debt-ridden company. It's not a good company to invest in. That is what the report says. But when I saw them sponsoring Chennai Super Kings and Chennai FC, that is in football and cricket, both the teams were sponsored by Apollo Tyres. So I said, if Apollo Tyres is sponsoring football and cricket, I would like to be the owner of this company. So I put in 3 lakhs and I bought the shares for 210 rupees initially. This was in 2018. But the day I bought it, the share price started going down. So I started buying more and more. Every month I put 1 lakh rupees. And by December 2019, I had invested 15 lakhs. I had managed to accumulate 8,800 shares. But my average price was 160 and today's price was 120. So it was showing minus 40. Minus 40 into 8,000
is almost around 3.2 lakhs loss. But fortunately, after that lockdown came, COVID time came, and you want to imagine the share price dropped down to 70 rupees. And when it dropped down to 70, I pumped in 5 lakh rupees and I bought shares at 70 rupees. Today, I'm the owner of 21,000 shares of Apollo Tyres, and my actual buying price has come down to 180. But today's price is 246 rupees.
Wow.
So from 180 to 246 and multiply by 21,000 and see the gains, it is 140%. But why? Because I stuck with this company in good times and in bad times. So investing is basically like getting married. And now I can give you guarantee now, since I have been 3 years with Apollo Tyres, I'm 100% sure by next year I'll get bonus shares. And as a shareholder and being an owner of this company, I have been getting dividends of 8 rupees, 9 rupees every year per share. So that is called passive income. But if you keep on changing the company now, because it's at 246, if I sell it off, I will make profit, but then I will have to search for another partner. But now once I'm married to this company, I should be married to this company for life. So that is what we call investing. So either you work for money or money works for you. So how you can do it is either you invest in your business or invest in somebody else's business. But when you invest in your business, you have to work 24/7. When you invest in somebody else's business, they will work and you will make money while sleeping. And that is what rich people do. Now, since you said you are working for Deloitte, can you imagine if I am a shareholder of Deloitte? You will be my employee. And that is the beauty about it. So shareholders always like to own companies. They don't like to trade with companies. So trading is different. Whereas saving is just keeping money for the rainy day, which even beggars do. Who doesn't save money? Even animals save for the rainy day. So saving is totally for the poor and middle class. Trading is more for the middle class, and investing is what the rich people do. So if you understand these 3 words properly, I'm telling you, anybody can grow rich.
Yeah, thank you so much, sir, for reiterating all the points and valid examples wherein our viewers will try to understand that how exactly the investing, saving and trading pattern will work for them also. The marriage and the dating portion is going to actually divert a lot of attention to our viewers, and marriage being a long-term commitment and ownership is definitely a very right solution. So you have totally made it simpler for our viewers to relate and correlate and understand the overall process of saving, investing and trading. Trust me, it's become a guru mantra for me and I'm going to take it forward. I hope, sir, with your experience with us was great, and it would be great if you could share some of your views and highlight something.
Basically, I must say a very big thank you to the Rotaract Club of Margao. Actually speaking, this Vaani program was really interesting, and for me it was an opportunity to come and share what I've been doing it like for all these years. Because for me what happens is, I strongly believe that financial literacy is the strongest weapon to eradicate corruption, poverty as well as disease. Now if you ask me why disease, because financial stress is the biggest cause of all the diseases that we have today in the world. So if you can relieve your financial stress, automatically your disease also come less, your corruption starts reducing, and of course everyone starts becoming rich. And I'll tell you my summary in the last sentence, which I always say: rich is not how much you have, rich is how much you give. The more you give, the more richer you are. The more you have, the more wealthier you are. And let me tell you, wealthy people usually don't go to heaven, it's the rich people who go to heaven. So if you want to go to heaven, you have to make a difference to other people's lives. You having that money doesn't give you satisfaction, but when you make a difference to other people's lives, you get that happiness. So try and make a difference to someone else by becoming an investor, because investors are the ones who become rich, savers are the ones who become wealthy. Like wealthy people have a lot of assets, they have a lot of gold, they have properties, but they don't have financial freedom. In the sense, even when they go and buy vegetables, they will bargain with the vegetable vendor. They will bargain with even the fruit vendor. So people who bargain cannot be called as rich. But people who give 10 rupees extra are the ones who are rich. So to grow rich, you need to give, not have. So this is what my message to all the Rotaracts, and I want you all to become rich and see to it that you start making your life of abundance. You should start living a life of pom-pom life. I don't know if you know what is pom-pom.
POM, plenty of money and peace of mind.
Yes.
If you have these things, you can enjoy life like anything. So thank you once again to the Rotaract Club of Margao for giving this opportunity and a very good host.
Thank you so much.
Thank you. It was a pleasure actually listening to you and asking questions because it was very easy to actually correlate with it. And you being in the financial field, definitely you'll understand how the finances work much better. So thank you for your hospitality as well as for the brief introduction.
Thank you, sir, for summarizing everything. And trust me, our viewers is going to love the insights you have given. And it's my pleasure that I could host you. And on behalf of Rotaract Club of Margao, we literally thank you from our heart. It was a pleasure having you.
Same.
Hope everyone enjoyed this session and had a lot of takeaways. I am Rotaractor Megvi Pangam signing off.
You're watching Vaani by Rotaract Club of Margao. We'll see you in the next episode.